Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at Twitter. We're going to talk about some information about the overall markets, about commodities and whatever else I'm sharing on my Twitter feed and what I'm retweeting. So we look at this stuff. We can gauge other people's charts. I can give you my financial opinion along with it. And we're going to dive in here and take a look at it. If you guys are interested in following me on Twitter, let me zoom in here real quick. You can follow me at finding_finance. Now, here's the 10 and 5 year inversion. And a lot of people talk about the yield curve and when it inverts. And what they say is it's always right about recessions. However, B of A notes with arrows, it is when the curve uninverts that is the signal. So here's the curve. This is the yield curve is always right about US recessions. When the curve uninverts, where the red arrows are located, that is when you start to see problems. And what that means is that basically, as you go further out in the curve, at least the way that I view it, it's a little bit more anchored than the short-term stuff. The short-term stuff moves more violently or more volatile than the long end of the curve for the most part. And what we see is we see the curve start to move. The short end starts to drop and the long end stays relatively more stable. And that's when the curve uninverts. So under an inflationary time frame, the short end starts to move faster than the long end, going into an inverted yield curve. Think of it as inflationary. Then as that inflation comes out of the system, people go and run back into bonds, pushing the short end down faster than the long end, uninverting the curve or normalizing the curve. And that's when you start to see these recessions. That's the dark gray lines and the arrows going up. So that's the curve uninverting. And that's when we see the contractions. Now, when we look at the most recent with the circle here, the question is, which way are we going to go? And what my take on it is that this is going to compress further to the downside. And why do I think that? I think that inflation isn't done yet. I think that we used short-term fixes in the to fix inflation or slow down inflation with the Freeport LNG terminal going down and with Strategic Petroleum Reserve releases. So I think that this is going to actually go down further. And obviously that's debatable, but I think we're going to go down further. I think we're going to push this winter upward, and inflation's going to go with it. We also have low base numbers from the year before. They're not super high at the end of last year. So I think that inflation is still a high likelihood. So I still think this will invert more. I don't think that this necessarily is a predictive factor. It's more of an indication of where we are. It's a measuring stick looking backwards is what this is. It's not a predictive function. So when I look at this, this is the PPI to CPI ratio. And if we were to kind of look at some of these time frames, so when this was going up from 71 to 74, we had a nice big move from 71 to 74. 71 all the way down to 74 was this move lower. So this inverting is more or less the PPI to CPI going on up. Then we had a kind of a pullback here all the way to 67 or so. 66, 67 right there. There's 77 right there. And then we pulled back on down, which is this coming back up all the way to 81. So it's basically this curve moving up and down inversely. So as this goes up, it means that the producer price index is outpacing the CPI. And that's kind of a leading indicator. If we look at what's happening recently, we've had a massive move off the bottom here, and we've hit our head on this upper trend line. We hit our head and we've come on back down. You'd say, well, why? So I'm going to go right to the tip here. That was June of 2022. We did a strategic petroleum reserve release in June, and we also had in June the Freeport LNG terminal go down. So if we were to look at June, if we're in particular PPI to CPI, remember the June number. If we look at crude oil futures and we go to, crude oil futures, and we go to the peak of crude oil here, that's June. June's the peak, and that's when we went lower. And if we look at natural gas and the peak in natural gas, since we've been following this together, I can tell you that the Freeport LNG terminal went down in June. So that was also in June where we headed back lower. We came up, and now we're heading back lower again. The Freeport facility LNG terminal is going back online in November. I think it goes to like 85% capacity or something like that in November, and then it goes back on up. Crude oil is also working its way higher here over the past, we got the trend line break to the upside. And I think this winter we're going to see inflationary pressures. So I think that when looking at this, that we're going to continue to go down, that the PPI to CPI ratio that I follow will go up this winter. And that's this guy right here. I think this is going to head higher and break out of its long-term downtrend line. Let me go on logarithmic here real quick. Back it out. I think that we're going to break to the upside here and rocket up higher here. And the reason for that is the price of oil and natural gas. That is my reasoning. Now, if the price of oil and natural gas don't go up, if they release more strategic petroleum reserve, it will delay the move. I don't know if it will stop the move. Like indefinitely stop it in terms of time frame. They can stop it for a little while, but I don't think they can stop it forever. But here is that hit. We came on back, and I think we're going to move on up. Or maybe we come up, break out, and do something like that. Whatever it is, it doesn't really matter what it looks like, the actual path. I think it's going to go higher because of the supply-demand fundamentals in the market of short supply of both natural gas and just energy in general, I should say. Energy in general is going to blow up your PPI to CPI. We can look at the PPI of, say, UK, right? The United Kingdom's producer price index. If we look at that, we look at some images here, this thing has been a moonshot. This is UK's PPI. It's rocketing higher here for its producer price index. They have energy constraints, and we can look at Germany's PPI. Germany for 2022, this thing is rocketing higher here, and it's even higher than that, I think, in most recent data. It is way up there. It is rocketing on up for EU, which is all driven by energy. So if energy is the driver of the producer price index and eventually the consumer price index, and the SPR releases come undone, I think we're going to go higher. If you were to look at some other stuff, Yellen, in terms of oil prices, I think she said gas prices, oil prices could spike in the winter. Even Yellen is seeing this, and she's talking about these spikes that could potentially happen in the winter. If that happens, what we're going to see is this PPI CPI come back to the upside, as the producer price index and consumer price index are driven mainly by oil, as that's the number one commodity. So I think that's what's coming ahead of us. That's what I'm still positioned for. And I know people see this, they get afraid that the yield curve's inverting, but that's not what drives the recession. It's the uninverting of the curve. And what that means is you're seeing the market slow down and you're seeing the demand for oil slow down. That is kind of your indicator. So if you were to look at what is important in the markets, you should be watching the inventories of oil, as that is the driver of these curves, in my opinion, which then ties to your PPI, producer price index. Those are your leading indicators. This is actually a lagging indicator. And I don't know if many people understand that. They look at this and, oh, it's going to go. They don't know where it's going to go. Yeah, we do know where it's going to go. Oil prices are what's driving this boat. Energy. And if energy's short and they come off with the SPR, the production supply side comes off a few million barrels from Russia, we get a little bit of demand go up in China and some other areas, we're back into the PPI increasing. And we're going to watch this real time. We're going to test what I'm saying real time on this channel. We're going to watch it together. We're going to watch this together. So here, we'll go to the next one. That was a long thing there. It says, the Fed tightening, U.S. government selling its strategic petroleum reserves, China imploding, dollar surging. Who cares? Energy stocks continue to significantly disconnect from the rest of the markets. Let's not forget, at 11% free cash flow yield, the overall sector remains insanely cheap. Energy is moving higher as everything else is moving lower. You've heard me say this. I've, on the Platinum membership, on our question and answer sessions, I'm mainly in a couple of certain areas: energy and precious metals, because energy is going to break the system, in my opinion. So energy and precious metals to save your butt from a currency problem. All the rest is heading lower. And we're seeing this, and this is a good depiction of the movements of energy. Now, in June is when they released the Strategic Petroleum Reserve. Don't get me wrong. Do not get that confused with other reasonings. Oh, it's a weakened demand. It's not weakened demand. The demand is still there. We're eating through our inventories like no other. This was a orchestrated manipulation of oil from the Strategic Petroleum Reserves around the world. And when that ends, and energy is still moving up in the face, now we've got OPEC and some of these countries battling against each other. And I don't know if OPEC has the oil that they think they can pump. They might be cutting back because they don't have the capacity. They don't have the oil, or they're cutting back because they don't like what the Western world is doing. And they're basically saying, screw you. It's that simple. Looking at the COMEX registered gold COMEX registered gold. Gold drops below 12.8 million ounces, lowest since July 1st, 2020. The vault totals remain at lowest level since May 26, 2020. Wait, we're eating through all our inventories, but the prices continue to go down. Are they being manipulated? I don't know. I don't really care. I'm going to buy the physical. Get me out of the system. These guys can have their bonds and their crashing currencies. Good luck with that. We've also got, again, the 10 and 5 year. Is this going to uninvert, or is this going to draw down further? I think that this has slowed down because of the Strategic Petroleum Reserve releases and because of natural gas and the Freeport LNG, if you're measuring it in dollar and U.S. Treasury yields. Everywhere else isn't getting that type of relief, and you can see their CPI and PPI numbers going to the moon. So that is really what's happening right here. Are we going to come back and uninvert, or are we going to continue to invert? I think that we have a chance of more inversion because of the SPR coming off. It's reliant on that. September saw the record for the largest combined monthly withdrawal from COMEX and LBMA silver vaults, coming in at almost 58.5 million ounces. Total combined withdrawals in 2022 now totaling 332.8 million ounces. Look at the silver drawdowns here. That's called a deficit, baby. It's happening in gold, it's happening in silver, it's happening in platinum. We are eating through the inventories. Keep the pressure on, guys. Keep it on. Keep accumulating. Get in this stuff before a problem happens. And that's what I'm doing. I'm getting in before the problem happens. I like platinum the most. At this point, I already own a good amount of silver, so I'm preferring platinum, but silver is also a good bet. A flush lower from the current support will be very ugly, and I think it's highly likely. This is the NASDAQ. I'm talking about that support level that we're basically playing with. We could head lower if we break through this support level. Highly depends on what the dollar does. Highly depends on what yields do. And they may be in there manipulating those yields. They may be buying bonds. We'll see. We'll see what happens here. This is the DXY. We're about We are above the green pivot low, which is bullish, but in a bearish wedge on the shorter term. Could this break lower as this thing squeezes up? I think so. And if you go in and look real close, we came with a good pullback, and now we're kind of struggling to go higher. I think the sellers are in control. Again, it's statistical probabilities, but I think lower on the DXY. I think that we could see lower on the 10-year yield in the short term, and then we'll have to see what happens when they stop the Strategic Petroleum Reserve releases in about a month or two. I said real estate prices are 13% higher than last year still. Active listings are stabilizing in inventory. So real estate's still going up year over year. I understand that it could be down month over month, but actually it's up month over month if you look at that actual price. But this is year over year. The new listings are actually coming off the market. There's not as much listings coming on. The inventories are stabilizing. You can see plus 27, plus 29, plus 30. They're starting to stabilize. And we do have time in the market staying about the same, 5-6 days slower. And that's what it looks like in a kind of a one-shot look at it for just that week. So that's real estate. And I know people are like, oh, it's a big bubble. Well, we have to see the prices come down on a year-over-year basis. They are slowing down, no doubt about that. But if we're in a highly inflationary environment and bonds are not safe, where is that money going to rotate? Where is it going to go? It can't all go into oil. It can't all go into energy. It can't all go into precious metals. Those markets aren't big enough. It has to be absorbed anywhere. So if we get into a currency crisis, you might see real estate go up or not. We'll have to see. I think commodities are the spot to be. I think precious metals will do very well. And real estate is still in the air. We'll have to see what it does. It says people are missing just how rapidly production will be declining. He's talking about oil. We will see a global deficit of a few million barrels per day next year. It's so much more important than the Fed toying with rates, but no one is talking about it. Russia will soon miss U.S. technology, capital, equipment, parts, expertise to effectively operate many of their declining oil fields. Expect Russian oil production to decline rapidly in the future. It says ratio defined gold target range 6,400 to 29,640. In less than 10 years, all gains for U.S. equities price in gold can vanish. Protect your wealth. And what this is the gold versus the S&P 500. You've got these long-term trend lines that we're breaking. So we broke that we broke this in the 1970s to go higher here. This was a big move from a low level, the breakout line here. We broke it, retested, and then went higher in the 1970s. It was a good, long, about 10-year run. We were in a disinflationary period from 1980 all the way to the bottom of 2000. We broke out in 2002 to the upside and started running. Remember, the buy signals for a lot of commodities were in 1998, 99 at this bottom here. We broke out in gold versus the S&P 500 in 02. It's delayed a little bit behind the rest. Then we ran all the way up, went into a disinflationary period with the business cycle. Now we are looking for a big move higher, and we're right about to break out of this early breakout line. So that's where we're at right now. It's looking very good for gold to break and move higher. And I know people are looking at the short term saying, oh, it's down. But we can see people positioning in the last few clips that I just showed you here. Some of the slides here. We saw that the inventories of silver and gold are drawing down. It's basically aligning itself for a move higher. The physical's being drained, guys. The move is about to come. I like that chart quite a bit. Here is a very close to confirmed breakdown on the weekly chart for the S&P 500 versus silver. So this is the S&P 500 divided by silver. The S&P going up against silver is S&P favorable. You can see that this thing is rounding the top out. It's slowing down, and we're getting larger selling pressure. We sold off very hard here, and we're struggling to come back up. This here looks very good for a break lower for silver out to outperform the S&P 500. We're also seeing inventories of gold and silver be drawn down with large deficits. The market has deficits and it's eating through the inventories. So again, I am positioning for what's about to come. And I could be early. I'm fine with that, but I'm going to continue to buy in those areas because the fundamentals are supporting it from the market deficits. That's the market conditions I talk about. We've got, check out this massive 100-year pitchfork channel for U.S. equities versus the producer price index. The producer price index is that gauge of inflation on the front end. Think of it as oil and natural gas, and we're right at the peak here. So it would be good or a benefit to be buying commodities at the tops of these levels here. In 1969, you'd be buying at the top and they compressed all the way to the bottom of this level, 74 and 80, 1980s. We are at a very high level and we could go all the way down to either the midpoint or all the way down to the bottom. I'm not exactly sure how much we're going to compress this, but I think it's going to get pretty interesting here very quickly. We do have a support level right where that circle is, and we'll continue to watch this over time. So I think the producer price index will outperform the S&P 500. They are inversely correlated, and I think we're going to see a big compression favorable for the producer price index. Here is, so this is what, so you think current daily price action will override the huge damage inflation did to the U.S. equities. The weakness in U.S. equities is very analogous to 1970, weight of evidence. And what we're seeing here is the SPX versus the producer price index zoomed in on it. And this chart here is showing a breakout to the downside. We're struggling to come back higher, which is our return move. We break out, we do a return move, and then we break down. So I think, again, producer price index will outperform, which means that this ratio is going to go down and be favorable for commodities and precious metals. And we're very early in this. All of this is changing in the system. This is a huge rounded bottom in the making. The green energy narrative is still marketed through mass media, but the narrative will change towards nuclear as is the only large-scale option. I completely agree with this. We've got a large inverted shoulder head shoulder in URA versus versus SPUT. We're coming on down, putting the shoulder, putting the head, putting the shoulder in here, and then we'll work our way higher. These are very long-term patterns. And ratio charts tell us when they're cheap. It doesn't tell us when it happens. It just tells us that I know for a fact that URA is cheap to SPUT, and we know that uranium is cheap to every other commodity in the world. It's probably the cheapest commodity at this point. So to be a contrarian and to be brave, you buy this. I buy this bottom, not advice. I buy this bottom when everybody hates it. You hold on to it, and then you wait for it to appreciate. Could there be further downside in the short term? There very well could be. But the risk reward down here is still absolutely fantastic. And people are getting scared because of the price movements. Uranium is one of the most volatile commodities, and that's why I've put a certain percentage of my portfolio at the percentage I did, and I'm riding it. Because that's what my risk tolerance and, it's not really risk, I should say, it's my tolerance to volatility. This one is the US 10-year yield. It says, I drew this chart and highlighted the pain line last year. And I really do like these guys as, North Star bad charts. They're long-term charts. Here's the resistance line. We've broken to the upside here. The breakout confirmation of a paradigm shift. I say that a lot, a paradigm shift. And we're going into our increasing interest rate environment as we go up. That's going to change the way that people view the world. Money's rotating around in the system right now and starting to align and move into energy. We saw that with the outperformance of energy in relationship to other sectors that Tavi had posted earlier in this clip. So it's all aligning here. The 10-year yield moving higher, the 30-year yield, the inverted yield curve, the inflation being driven by oil, and all of the outperformance of energy in relationship to other sectors. It all is tied together. And what I'm doing with this channel is I'm sharing all this information to help you guys out. I can also help you out with the Finding Value website, the Platinum membership, if you guys want to know what the highest leverage is in the system in terms of the companies. You can also directly ask me how I'm playing it, why am I selecting certain companies, which ones have the largest cash flows, to play exactly what we're doing. I also look a lot of the uranium companies and say these are the ones that are striking, and these are the ones that I think that have the highest probability of bet for an explorer, for a developer, and how I'm positioning in those. There's two main things to get right when you invest. Three, I should say. There's three main things. You got to get the value right. You got to identify where the value is, find out what's cheap, and then you need to know how to value it when you sell when it's expensive. That's a big factor in becoming successful in investing. You have to value assets properly. The second one is to understand when market conditions come and when money rotates and those valuations change. That is a big thing that a lot of people do not get right. You can get the value right, but you don't know when the market conditions are going to change for those valuations to change from undervalued to overvalued. So the market conditions are driving that valuation change. That's why we look at inventory levels of oil. We look at inventory levels of anything. That's why we know where the cost curves are at. If you're buying physical metals and you can buy below the high cost of production in the cost curves, you're going to win. Then it's just a matter of time. If you can see that the market conditions are changing, if you see the deficits eating through the inventories, we're seeing silver inventories decline, we're seeing gold inventories decline, platinum inventories decline, natural gas is at low levels, coal's at low levels, and we've got oil at low levels, and we're eating through those inventories. Those are all positive market conditions for prices to go up. The question that a lot of people ask when they're newer investors, how come we're seeing the inventory levels decline and this at the same time we're seeing the prices decline? Sometimes that happens. The markets are forward looking and they're looking at a possible recession. So now they're trying to weigh the risk of a recession with the demand and supply of the future. They don't get that right all the time. If the inventories continue to decline, that is a fact. They're speculating on what those inventories will do in the future, given where the inventory levels are at today. And sometimes they get it right, sometimes they don't. And it's when they wake up and becoming a successful investor is basically realizing that we have a problem before other people realize it and accurately identifying that problem before others. That's really what it is. And right now, I think, at least in my opinion, that the supply side is so damaged in energy that it's going to impact the CPI. It's going to impact all these other measurements. And right now, since we're using the Strategic Petroleum Reserve releases, Freeport is down, I don't think people are accurately measuring those risks in the market. I think that they think that demand is pulling back and we're starting to see softness, but it's not. We're just eating through our inventories and accounting for the inventories differently. We're moving it from strategic petroleum reserves and saving some of our commercial inventories. It's not an actual decline in demand. So I'm betting, at least my take on it is I'm betting on energy going up this winter because of those imbalances. And that's going to impact interest rates. It's going to impact the yield curve. It's going to invert more, I think. And I think that everything is broken out in terms of yields to the upside. And I think that will continue. I don't think that we have demand destruction, at least not yet. So that's my take on it. Again, if you guys need help in navigating the markets, that's the market condition aspect. The other aspect that you have to get right to be an investor is you have to choose good, solid companies for the move. And I use that using technical analysis. I use that using fundamental analysis. And I want them to align. I want the fundamentals and the technicals to align. And I want large fractals for big leveraged moves in the future. And I talk a lot about the companies that I'm in. You can see my portfolio. The portfolio just gives you the overweighting and normal weights in my portfolio that you can see. And I've chosen to overweight a lot of the highly leveraged companies in this move. The leverage is what gets you those big returns. And if you don't like the leverage, you're going to have to choose something else. Something like a larger company or a dividend payer. And it's good to spread across a bunch of those. But that's what I've got for today, guys. Hopefully you enjoyed the clip. Give me a thumb up. Subscribe to the channel if you haven't. And definitely subscribe to the website, the Platinum membership, if you'd like to. All right, guys, we'll catch you next time. This is Finding Value.